Well, hi there, everyone, and welcome to the VIP Trade Room with Roger Scott and Matt Horton. Now, today is Monday, October 27th, and my name is Raleigh White, and I'm coming to you live from a really nice, kind of a fall day here in Austin, Texas. We got some cool weather moving in, and boy, is it appreciated. Anyway, I'm going to be your moderator today, and in today's session, Roger's going to be covering a range of important topics with a focus on Heiken Ashi candles. Now, in today's agenda, he's going to share what they are and how to use them. He's going to share with us when they work and when they don't. He's going to share with us daily versus intraday Heiken Ashi candles. He's going to also, folks, review implied volatility and the impact they can have on your trade decisions. He's going to talk about what the MAR ratio is and not ration, it should be ratio, what the MAR ratio is and how to use it. And then as an extra special bonus today, he's going to share with us a system that regularly beats the SPY with about half the drawdown. So exciting session today for what's on tap on VIP. And as Roger mentioned earlier this morning, he's been spending about 3 days getting ready for today's agenda. So I think we all should be looking forward to that. Now, if you've got any questions during Roger's presentation, please type them in the chat window and we'll address them periodically throughout the session so as to not interfere with Roger's presentation. Also, folks, please note that the chat is open to everyone, and remember the ground rules. Number one, always be kind and supportive in your posts. Number two, keep to the topic. Number three, no political discussions allowed whatsoever. And also, folks, please keep your side conversations to a bare minimum so that the rest of us can focus on the education and information that Roger's sharing, because after all, he's spending time with us to give us an edge and to help us all become more confident and consistent in our trading activities. Now, for those of you that were with us this morning during the 8 a.m. pre-show that market pre-open that Roger does, we'll note that there were several catalysts that were on top today. In chips, we noted that Micron and Marvell were both up 3% coming into the open. On the mags, we saw that NVIDIA was up 2 points, Amazon was up 1 point, and Microsoft was up 1 point. On the consumer staple side, we noticed that Keurig Dr. Pepper, they had earnings scheduled to come out before market open. And then natural resources, we don't talk about this sector much, but we saw that METC was down 5% and MP was down 4%. A lot of focus there on rare earth minerals, and they were taking a hit coming into today's open. As far as other things to concern, Asia, Japan, and Chinese markets were on record highs, and a lot of that was fueled by anticipation of what may come from the meeting between President Trump and Premier Xi on Thursday. And finally, with regard to the Fed, we noted that we had the Richmond Manufacturing Index coming out and consumer confidence. Consumer confidence, kind of a question mark, because still not sure if that data is going to be published with the shutdown ongoing and impacting the ability for us to receive these reports. Now, for those of you that may be wondering, well, what's the importance of these catalysts? What are these catalysts? Why do we report these? Well, the key thing is this, is that we believe that information that is known or will be known during the trading session and is not yet priced into the market are things that we need to pay attention to. That's the definition of a catalyst for Roger, and that's why we post these things. Just be careful when looking at opportunities around the sectors that are mentioned and around the events that are occurring. Now, as far as today's small cap watch list is concerned, Roger shared with us 8 tickers today: RECT, BKYI, CLIK, BRTX, JXXN, TGL, CODX, and SOHO, SOHO. Now, remember, folks, when Roger looks at these opportunities, he's focused on a couple of things: price action, but more importantly, extreme pre-market volume. And when I say extreme, I'm talking about volume that's maybe 100 times what the normal volume is for this small cap stock. Also, remember that these opportunities should only be considered after the market opens. And if you don't see an entry before 2 p.m. Eastern time, don't bother. It's not worth the risk. And also, folks, never hold your positions overnight. If you get into one of these trades, once again, take your profit and get out. But don't hold them overnight, because you will be have a nasty, nasty thing happen to you in store if you do that. So why don't we take a look at these small caps, and let me pull up my chart and let's take a look at how they're doing. As you saw, there were 8 of them that we were focused on today, and I believe you can see my charts. Let me make sure. Yep, everything's good there. You can see my chart. So here in the upper left-hand corner, we see RECT. The pre-market high was $10.04, and we nothing. Snooze fest here. The next one over here, BKYI. The pre-market open was $2.28. Once again, the market open and it's just drifting lower. We look at CLIK. The pre-market high was $18.31, and it's just been chopping sideways here as well, not even coming close to sniffing that level. As far as Soho is concerned, the pre-market high was $2.25, also just moving sideways, nothing exciting there. In the lower left-hand corner, BRTX, pre-market high, $2.10. Much like the other markets, just moving sideways, nothing to write home about. JZXN pre-market high was 67 cents, and it's just been moving sideways, nothing there whatsoever. TGL pre-market high was $1.54, and it hasn't done anything. And then we have Codex, CODX. The pre-market high was 69 cents, and look at what this guy did. It just took off like a rocket. So it just reached its current high, and 1.25. Let me do something real quick. I'll do the math for you. Divided by 69 equals, and it is, oops, that's not right. 1.25 divided by 0.69 equals, and it's up a whopping 81%. So this is what we like to see when we see them. This is the potential with these small caps. Once again, came into the open, shot right through what the pre-market high was, and has moved higher, and once again has done well for everyone as far as that's concerned. So that's what we saw there. So anyway, small caps, 8 of them, and one of them definitely hit today. So let's go back to the normal presentation. And we also noted that Roger's pre-market stocks watch list. Now, these are the large caps that he's got his eyes on, and his shorts, we see them here: GKOS, EEFT, NOMD, TREX, MAN, CHH, KNF, and INGR. Also, as far as the longs were concerned, VSAT, CLS, Bank of America, Google, Apple, LRCX, VRT, MS, LITE, and GH. Now, remember, Roger, the caveats right here. Number one, for those that are basically on the long side, and I'll cover this a little bit more in his pre-market comments, we note at this point that the markets are overextended, and you need to be careful about those. You want to wait for a pullback on that. Secondly, this is Roger's watch list. And what does that watch list mean for Roger? It means these are stocks that he's looking at. And if they reach specific levels and setups that he's looking for, then these will be turned in to trade ideas and alerts that he typically will share in the trading pit. And he also recommends that for any of you that are considering taking these longs or shorts, that you're absolutely certain and comfortable with the setup that you're seeing before entering those trades. So far as his pre-market comments were concerned, the markets were up big across the board. Boy, were they open big above the board. And that's the futures markets coming in. We're responding extremely positive to news that there's a framework in place that President Trump and Premier Xi are going to be talking about on Thursday that could have a big settling effect on the tariffs between our two companies. We also noted, though, that volatility was moving lower into its range below 17, which is where we like to see it. Normally, that makes good sense. There were some red flags, however. Roger shared the pull to call ratio, and it's at the lowest level since June 10th, 2024. And he shared what the markets looked like then and shared what could happen now. Also, red flags. Bonds were drifting lower and the sectors were fragmented. Despite all the movement overnight or whatnot, the sectors were fragmented between defensive and speculative sectors. Also, red flag, we noted that the SPY, the QQQ, the MAGs, and the MHS were all way overextended. So very, very dangerous to considering that that's going to move a bit higher. And he said, look, folks, for the first half of the day, this is a great opportunity to take profits. And let's wait to see until after 10:30 if the markets continue to hold up and to confirm what they're doing. So today's agenda, folks, Roger's going to be talking, and he's going to be very, very focused on these Hikinachi candles. He's going to share what they are and how to use them. He's also going to share when they work and when they don't. He's going to tell us about daily versus intraday Hikinashi candles. And in addition to all that, folks, he's going to re-review his discussion about implied volatility and the impact it has on your trading selections. He's going to tell us about the MAR ratio, not ration, the MAR ratio and how to use it. And then he's also, as a very special bonus, going to trade a trading system that beats the SPY on a regular basis with about half the drawdown. And with that, folks, it's so good to see everyone here. And let's welcome Roger to the room. Roger, how you doing? We also have Matt here. And I also know that Blake is with us, Roger. He's going to help us with moderation when we get into the second half of today's session.
Excellent. Good. Richard says squeak by with a $25 profit on Tesla after a rebound. Good, Richard. Good. Remember, folks, we're talking about Tesla, Raleigh, because I gave a Tesla trade in the pit. And it's up about $1.40 since we gave it, about $1.50 right now since we gave it. As I mentioned, it was a day trade. Roger, no emails went out. No emails went out today. What? How could that be? Can we make sure? Can you make sure Deanna sent out the emails, Matt? Let me forward this to, 1 second.
I got the Telegram.
Yeah. Oh, you already got the Telegram. Can you put it in Trading Zone too? You already got it there. Yeah. Did anybody get an email today? Murray got an email. I think it was just Andrew got the email. There they are. Oh, now you got the email. Okay. All right. Okay. Who else except for Bob had a chance, Robert got a chance to take the Tesla trade? I gave you guys Tesla today. I told you guys that I gave you the full narrative. Just want to make sure. Nice trade. Chris took it. Anybody else? Let me know. Missed it. It happens. It happened. David got it. Okay. I gave you guys Tesla right around here. Let me just share my screen. And by the way, do you know what I used to give you that Tesla trade? You want to take a guess, Raleigh?
I want to think, let's see, the Tesla trade. What did you use? I think you might have used the brand new dashboard.
Nope.
That's what I think. Nope. Okay. Then data miner comes to mind.
Hikinachi.
See now, Roger, I was just setting myself up.
Hikinachi.
And I always want to say Gesundheit after you say that. But anyway, I'm looking forward to this, Roger, because I am only peripherally aware of what they are and what they do and why there's importance. So selfishly for me, I'm looking forward to hear about their importance and how we can use them.
Good. Well, it's going to be a great session. All right. First off, Trading Pit didn't receive the alert. Don, it's right here, guys. Look. Hey, Don, let me show you. I don't know why people keep putting bananas in here. We got it right here. Go long Tesla, maybe a day trade, 1150. I gave you a fill at 455.18 a minute later. A minute after that, we took our first fill. Then I told you where it is as I'm guiding you through the trade. It's right now it went all the way up to 566.95, and our entry was at 455.18. So there was this. It definitely got some air. Now it says right now I don't trust the market, so day trading and scalping is. This is still about Tesla. Remember, I never give a day trade without being a good swing trade, showing you how Tesla is breaking out on a daily chart out of a level here in case somebody wants to trade it. Here you go. Clyde is the troublemaker. Speaking of Tesla, it's back at our exit price. If you missed it, that's 9 minutes later. Again, Tesla is now at 467.70. If you missed it. So I'm curious, Don, what was it that you missed exactly? Uh, all right. Esther, the reason I give you the fill price on Tesla is so you guys don't chase it, but obviously you don't have to worry about chasing it. You got a better price than all of us put together. Okay, so let's talk a little bit about the market. On a daily chart, as I mentioned, we're a little overextended. What did I say today most likely scenario was going to be? I said it several hours ago. I said we're probably going to gap up and consolidate and go sideways. Well, it's been doing that. It's been doing that for it was doing that till about 11:50, and now we started getting a little more upside. And when I started seeing this upside, this is what I wanted. This is why I wanted to go long Tesla, because I saw a HA on Tesla. Tesla was trending and outperforming the market on my Pro Trader dashboard, and it started printing green HA reversal candles.
Wow.
So there was three reasons why I wanted to.
And
give you that
Roger,
trade.
your parting statement to us as you left this morning was, "Hey guys, sit on your hands, wait until 10:30, and let's
Yes.
see if this level holds or if things are going to fall off or they move higher." That was the waiting point.
I actually said one more thing in addition to that. I said something at the last second before people left. And that was, and I said this very nonchalantly, and let's see who actually paid attention. I said, watch for stocks that start breaking out after 10:30, 11 o'clock.
Right.
10:30 and 11 o'clock. And wanted to show you something here. Guess what I was doing today at that time? What stock started breaking out at 11 o'clock? Not at 9:30, 10 o'clock with the market. What stock, when the market was doing nothing, when the market was doing this, I was looking at stocks that are starting to pop out. I'm actually going to be, this is a world exclusive, premier exclusive. I'm going to actually be adding another filter to the Pro Trader dashboard that doesn't just look for breakouts at 10 o'clock, but also looks for breakouts after 11 o'clock when the markets die down. Because I'm finding out that those breakouts tend to work the best, because those breakouts are really, really, we basically, they happen right after the market's like, okay, I'm done. I'm going to go to sleep. And then stocks start really moving. Those are the stocks. Now, Cyrus, I'm not going to change it from 10 o'clock to 11:30. I'm going to add another filter that does it at 11:30. So we have a double whammy. So Pro Trader Dashboard is going to be able to give you alerts for stocks that are breaking out at 10 o'clock and also give you stocks that are breaking out freshly at 11 o'clock.
Wow,
That
great.
that way we get a breakout after the first half hour, and then we get a breakout after the first 90 minutes. What's so special about the first 90 minutes? We get to see what's really moving, not based on the opening. Basically, the opening doesn't help. You see how I'm always thinking of how to help you guys? I'm always looking for the next angle. Why is this happening? My mom, I don't know yet. She's in surgery right now, and this is really keeping my mind off of it. So I'm just going to focus on this right now. I'm going to try to be as calm as I can, and I'm going to just try to focus on this. As soon as I get an update on her, my wife said she's going to text me, and I'll let you guys know.
Okay, Roger.
Okay, but I'm trying to just kind of focus on this, and I practice what I preach. I'm in the now. I don't want to go back, and I don't want to go forward. I want to be in the now. Okay, folks, if you're trading, thank you. I appreciate it all. That's where you want to be. You want to be in the now. Okay. All right, and I really like how Tesla's breaking out here. Notice it's trading above all of these levels. I gave you this breakout level last week, and I gave you this channel. I gave you this breakout level last week. I gave you this 590.91. It's doing that right now. Look at the SPY, how overextended the SPY is. Look at where we are right now, and look at Tesla. So I'm not seeing that. What I'm trying to say is I think Tesla has a little room here. So whenever I give you a stock in the pit and I'm always thinking I'm assuming you're gonna miss my trade and you're gonna end up getting stuck for a swing trade. That's my assumption. Okay. I presume that. Okay. If I'm wrong, then you make more money. And by the way, if you were late, if you didn't get out at my exit, you could still get out above our exit price right now. Just so you know, still can get out. We got out right here, and your exit is right there, and that's 20 minutes now. Okay, so there's a couple of things I want to talk about. I wanted to first before I get into HA clouds, I want to give you a free position trading system. Now this is based on if you missed my session, do you guys remember I had a session on the MAR? And that's when I went into how I knew that Kathy Woods was full of shit. Remember that? I gave you specific examples.
You're
I'm going
so
to
on the
show it.
fence about her, Roger. You're so on the fence.
I know. But I'm going to actually show you how I did it right now. And I'm going to teach you. So I'm going to teach you 5 things right now. I'm going to show you right now how institutional traders actually trade. They don't trade individual trades. They trade their system. They trade their account. I'm going to show you how institutional traders look at their portfolio. I'm going to show you why you should never, ever, 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 ever in a trillion years listen to anybody who just tells you how much money they made without telling you how much money they risked to make it. Okay? So I'm going to open up your eyes right now to a lot of things that you've never been exposed to because you don't know a lot of institutional traders, and the ones that tell you they are, they're lying to you. So let
Well,
me show you.
Raj, if I
Yes.
could just interject just one moment, because I want to bring you up to date on the fact that one of your small caps is doing
Mm-hmm.
extremely well today. CODX, it was a cheapie. The pre-market high was 69 cents and its high was $1.25. So it jumped 81% at the open.
Let me ask you, that's good to know. So that's what, 4 out of 4 now?
Yes.
All right, that's 4 out of 4. And let me ask you another question. Did any of the other ones hit?
No,
That's the
not
key.
not even close. Yep.
That's the key. That's the key. That's the key. You see, folks, how does she stay in? Well, she doesn't, Chris. She's about to get sued. But I'm going to show you something. And while I teach you all of this stuff that I've been discussing, I'll also give you a position trading system on the QQQ that's beaten it by a factor of 2 to 1.
Wow.
Do you guys want to see any of this?
Yes.
I've been waiting for this all weekend. I've been working on this all weekend behind the scenes. Okay? All weekend. I don't know. I don't know if I could do anything more to help you guys out than I'm doing already. All right, let's start. So I'm going to give you the rules. Because without the rules, you're not gonna learn anything. So let me give you the rules. Here. The super duper QQQ system that outperforms the market 2 to 1 for free. That's going to be the name of it, okay? And I'm going to share it with you right now. It's a very, very complex system. I'm just warning you right now. You may need a PhD degree to figure it out, okay? So I'm just warning you ahead of time. You may all need a PhD degree, okay? Are you ready for this, Raleigh?
Yeah, let's go for it.
All right, all you post-PhD math wizards. Okay, that's the rules. Yes, that's the rules. So we're using weekly data on the QQQ. If price closes above the 190-day moving average, we go long. You could use the 200. I won't tell anybody. And when it closes below the 200-day moving average, you liquidate it. Did all of you post PhD mathematicians get that advanced formula?
I'm still trying to parse it. It's
All
still
right.
crunching for me.
All right.
That's it, Roger. That's it.
The best systems have 5 rules or less. I've been only telling that for folks for 8 years now. Now, you probably want to see how well it does.
Yeah.
Right? I mean, after all, what's the point of seeing something and not seeing how well it does? So let me see if I could blow it up a little bit for you. This is going to be the best session you guys have had in a very long time. I'm very motivated to share today. Here. I guess this is as good as it's going to get. But I can blow it up on my computer. I just realized that. Here, I can blow it up. Okay. You guys should be able to see it. All right. I'm zooming in right now, okay?
Oh, there you go.
Okay. It's not going to be clear, but I'm zooming in right now. So first things first. First things first. This is the NASDAQ. This is the NASDAQ. Buy and hold. This is the system that I'm about to teach you. The rules are right here. You guys all have them, okay? It's very advanced, very, very complicated. Should take you about 10 seconds to figure it out. Now, how does it do? Scooby-Dooby-Doo. Let's see. Oops, sorry, I'm not trying to confuse you. I'm just trying to blow it up. Okay. So the equity curve is really good. This is tested from 2000, I think, 8 till now.
Okay.
The average return on our system is 12.45%. Okay. This is now while I'm doing this, Larry, instead of asking me what a good QQQ ETF is, pay attention. What I'm showing you is a lot more important than any question you could possibly be asking me. I promise you. I could charge maybe $10,000 for this session if I wanted to, and I would get buyers. Please pay attention. I'm going to open up your eyes for you. You will never look at the market the same way again after I'm done with this exercise. This is important. Okay. I don't know how else to tell you this. Okay. So if you were to go to the supermarket and buy the QQQ, buy and hold, your average return would be 14.5% per year on average. Okay. Capiche? My system gives you an average annual return of 12.45. Now, here you're in the market 100% of the time. Here you're in the market 15% of the time. Am I sharing my screen, guys?
Yep, we see it.
I am. Rebecca, I'm sharing my screen. Now, this is this test took only 24 years into account. Okay, it's not that many years. Now, the first thing you're probably asking yourself is, well, Roger, I hate to tell you this, but you said you're going to show us a system that's outperformed the NASDAQ 100. You're not doing that. Your NASDAQ 100 is giving us 14.5% per year, but your system's giving us 12.45% per year. You suck. Okay. Maybe I could redeem myself. If you trade the QQQ, your biggest drawdown would be 51.68%. Okay. My drawdown would be 24.17%. Oh, wow. My risk adjusted return is 82%, but that's not going to tell you anything. Now, here's where things get really interesting. And here's all the performance and all the other stuff. And I'll give you all of this. Please don't waste your time writing this down because that's not the point of this exercise. The point of this exercise is to show you this. Come on. There we go. You see this right here? This is the equity curve. This is what nobody talks about because, well, it's not sexy. And if people talked about this, you wouldn't really buy into their strategies and their bullshit. But what do? I expose things to you. I don't hide from anything. I go straight up with you guys. I want to be as honest as possible because I want to rock your world and show you how the world really works. So what this is called the drawdown, okay? This is a drawdown. And in the old days, back when I was a child, we used to take the average of this annual return, which is 12.45%, and we used to take the average of this. And we would divide this into this, and that's how we would get our MAR ratio. But something happened in early 2000s. We had a huge drawdown. And after that, every institutional trader decided to change how they use the MAR ratio. They decided to handicap themselves by using the worst drawdown in comparison to the average annual return. If we used the average annual return and if we used the average drawdown, our MAR ratio would be 1. because our average drawdown would be about 12%, 12%, 12%. But we look at the worst case scenario. And if you're going to write something right now, then I know that you're not listening to anything I'm saying. And what I'm saying is hyper important to everything you do, not just our strategies, the way you look at the market from now on. Okay. You will never ever look at the market the same day again after I'm done with what I'm teaching you right now. Okay. So you see right here, the biggest drawdown was 24.17%. Okay. All right. So we divide this into this, we get 0.50, not 1, but 0.50. So our MAR here is about 0.50. 0.50 is about the average of what most institutional traders get. They get between 0.25 and 0.50. I try to go for a MAR of 2 to 3, which means this number is 3 times bigger than this number. And yes, you're going to want to rewatch this video at least 5 times. So Roger, you said something very interesting and you lied to us. You said that this number right here outperformed this number, but it didn't. And you're right, it didn't. But let me ask you an interesting question, and I hope you all have your calculators ready. What if, Larry, what if instead of trading the QQQ, I traded the double leveraged QQQ? Can somebody tell me? Now, this is a good time for you guys to open your mouths. What would this number be and what would this number be? Please just answer my question. No, just don't I don't want to hear nonsense. I just want you to answer my question. What would, if I was using a double leveraged, no, don't give me the MAR ratio. Just give me the percentage return. How much would I make here and how much would I lose here? I know it's double, but some people they can't calculate. Just give them the number. Can somebody just do the number, do the calculation? This would be 48.34. And this would be 24.90. Did I make any mistakes in my calculations? And I hope somebody is actually going to write it down. Thank you, Catherine. This is 12.45 and this is 24.17. I'm not asking you for your opinion. I'm asking you for math. Simple math. 48.34. But what about this one? What about this one? Trust me, I'm going somewhere with this. How about this? Let's write. Thank you, Bill. Thank you. How about we write them together? How about we write them together next to each other? How about we write 24.9 win and with a max drawdown of 48.34%? Can one person do that for me here? Can one person do that for me here? Thank you. Now stop writing. You're done writing. Your writing days are over. So let me ask you guys a question. Stop writing. Stop writing. Stop writing. So let me understand this correctly. If I trade exactly the same strategy, if I don't change anything, I could make an annual return of almost 25% here. Wow. Hold on a second. I got to write this down. I want to write this down. This is important stuff. We got to write this down. I want you guys to understand what I'm going with this. Where's my... Okay. So this number right here becomes 24.9 right here. What is this number right here, folks? Hold on. Let me open it up again. What is my number over here, folks? 14.5. What is my new number over here? 24.9. But Roger, you're cheating. You're using a regular ETF here, but you're using a regular and you're using a double. Okay, I am cheating. You're right. You caught me red-handed. But wait a minute, wait a minute, wait a minute, wait a minute. Let's do the second part of the equation. Let's do the second part of the equation. 48% and 24%. Wait a minute, wait a minute, wait a minute. Are you telling me, Mike, I don't know how options got into this conversation, my friend. So let me get this straight. Raleigh, tell me if my math is off, right?
Okay.
Here, my biggest drawdown is 48%. And here, my drawdown is 51%.
Mm-hmm.
What's lower?
That.
And here, I made 24%. And
right.
here, I made 14%.
Mm-hmm.
What's higher?
There. Yeah.
And you know how long I'm in the market for? Less than 20% of the time. So what did you guys just learn here? What did you guys just learn here? Remember volume? Do you remember I taught you once that once you have a record and the record is pressed and the producer and the director and everybody's done with it, and once it's a finished record, you can't make the record better or worse. You can just make it louder or quieter. Okay? So what I just did was I took a system that was making 12% a year, but had very low drawdowns. That was better than a buy and hold system by a factor of almost 2 to 1. And all I did was turn up the amplifier. So let me ask you guys an interesting question. When somebody tells you, Roger, I traded your Alpha Zone Pro and I made $500,385.05. Are you getting this part of the equation or are you getting only this part of the equation? SZ, you're not asking the right question, my friend. The best thing you could do, SZ, is not to ask questions. Okay. Cyrus, really? 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 Both? Cyrus, I'm going to ask you that question again. When somebody gives you their performance numbers and says, I made 500% on this trade. Woo, yeah. But and I took an 80% drawdown. You hear that? You hear that, Cyrus? Because I haven't heard that once. Let's ask Cyrus that question again. When you hear these fantastic performance numbers, do you ever hear the drawdown part? Yeah, it's the mic. Has anybody ever given you a drawdown? Never. No. Never. So I'm going to ask you an interesting question. What's the value of this number without this number? Thank you. Completely misleading, no basis whatsoever. Thank you. Finally, do you guys understand the value of this lesson? Aside from giving you a system that's outperforming the S&P 500, NASDAQ 100 with a half of its drawdown. So what did we accomplish during this session? We've accomplished several things. First of all, I showed you a NASDAQ system that you can double leverage and mimic the performance of the NASDAQ with the same drawdown, but you'll get twice the return. You're welcome. I also gave you a good way to gauge when you should be in the market and when you shouldn't be in the market. Right? I also gave you a way to really look at performance. Without this, my friends, this is useless. Okay. Remember that guy, Richard Dennis? That guy I keep talking about, the turtle trader that my partner Curtis Faith used to work for. Do you know what most people don't know, Raleigh? They weren't managing institutional money. They were managing their own money.
Mm-hmm.
Sometimes they had drawdowns of 130%. But Richard knew that eventually, which means they were bankrupt. Richard knew that eventually a trend would happen in the world, and he just kept putting money in. But that never got published anywhere. So that brings us to our question. How did I know that Kathy Woods was a fraud? I looked up her drawdowns. and her drawdowns were that of a triple leveraged QQQ. So I knew that when the market was going to go down, she was going to go down 3 times as much as an average hedge fund. Now you have the full picture. Does everybody understand why I explained to you this is going to be really important? So what you should have learned today is don't ever, ever, ever trust the number on the top if you don't have the number on the bottom. Do you understand that? Don't ever trust the number on the top if you don't have the number on the bottom. The number on the top is only half of the equation. The way you count how much portfolio returns make is how much money you make in light of the risk that you assume, not how much money you make. Okay? So if you want to talk to a real professional trader and he shows you their performance, say, how much did this performance cost you? That's this part right here. How much heat did you take and for how long did you take it? And that's something, my friends, that nobody has ever explained to you before. Am I correct?
Yeah, the key thing is this, Roger. It's not been explained, but we've all experienced it.
Oh, you sure have. You sure have.
We know the impact of what a drawdown is, and we've all been there with it.
So now please do me a favor. If you start asking me questions that are not directly related to this, I know that you guys did not get what I'm saying, because if you got what I'm saying, you'd be going, holy shit. The first thing I need to do is check out my mutual fund to see what the biggest drawdown is and compare it against the returns to see really how the guy who's running the show is performing. That's what I would be doing right now. After thanking me. That's what I'd be doing right now. Now, what I just showed you right now is called institutional grade trading tools. Okay? No, I can't, Murmus. No. That's not where we're not there right now. Okay? So, folks, don't ever tell me how much money. Now, if you made money on an individual trade, that's fine. But remember, you're not trading your individual trade. You're trading your portfolio, your account. Because at the end of the year, you're not going to say, Roger, you gave me 15 trades, but I took 80 others. And that's not how it works. You look at your account balance. Look at your maximum drawdown. Okay? Look at your number. Look at your drawdown. Omar, look at your drawdown. You know what can help you avoid drawdowns? Big drawdowns? Correlated positions. Kathy Woods. All she did was just buy a bunch of related tech stocks during a bullish bull market. And when all of those tech stocks went up, she was making 3 times the money of a regular hedge fund. But when it came down, her drawdown was 3 times bigger than the average drawdown. But folks don't see it that way. Okay? So let me ask you guys, was this lesson valuable to you? How valuable was this lesson to you? Was it eye-opening to you? This is professional trading stuff. This is not your entry and exit nonsense. Okay, good. I wanted to make sure. And Gloria, see, okay, now I know that I made it. Gloria says I need to process it. That's what I'm hoping you would say. That Glenn said a $3,000 lesson for sure. Yes. This is not the stuff that you're going to get by reading your favorite trading book. What I'm teaching you guys is things that took me years to figure out when I was back testing systems. Okay? And most gurus won't tell you this. Most gurus will not tell you this because they don't even understand it themselves. Okay. Raleigh, have you ever heard of anyone talking about this?
No,
Okay. How
no,
long have
no.
you been
I
doing
mean,
how
yeah.
long have you been doing this, my friend?
Oh my gosh, almost 20 years. But in all honesty, way back at the beginning, just working with a very, very good mentor and looking at learning systems and doing our own testing before we go live money, it was pretty much hammered into us that we needed to understand our drawdowns.
And if
At
you
that
want to
point, if
right,
I if we
right.
wanted to evaluate, this particular strategy and does it make sense go, and then I'm sitting there, I'm going, this is total newbie time, Roger, and I'm sitting there and I'm writing into a log,
Yeah.
what all these day trades that I was taking, etc. And it was very, very important not just to focus on what was being made, but the drawdown and versus the equity curve, was extremely important. But outside of that entry level, really not, you know.
So folks, when somebody tells you we've made 50% average annual return every year for the last 30 years, at what cost, buddy? At what cost? How much did it cost you? See, folks, I could make 100% return a year. I could make 200% return. I could make 300%. I could make 1,000 return. But at what cost?
Mhm.
Capiche? At what cost? All right. All right. Now let's move on. Whew, I wanted to get that out of the way. And by the way, Murmis, here's the rules for it. I could make it in Stock Fetcher. I could probably post this in Stock Fetcher and it will work. This is a very, 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 very basic system. It basically tells you that you're going to go long when we're above the 200-day moving average and we're short and not to do anything. This is a long only system. It's been tested for 24 years and it's basically telling you not to trade when we're below the 200-day moving average. Now, I'm going to help you. I'm going to take this one step further. I don't want you to use this as a trading system. What I want you to do is use this as an eye-opening exercise to see how crappy it is to hold stocks when stocks are trading below the 200-day moving average. Draw down 24%. Look at the difference. Look at the difference in the drawdown, Murmus. This is why I tell you that the 200-day moving average is the time when we're below it is to short 51 versus 24. You save yourself half of your drawdown, folks. Okay, let me tie it up and put it in a bow tie for you. For all of you investors, if you're aggressive investors, don't be in long stocks. Don't be in NASDAQ long stocks when the NASDAQ QQQ is trading below the 200-day moving average. That's what you need to get out of this. So what I did was I showed you something. What I'm trying to do is show you 5, 6 things at the same time, put them together and explain to you how they all. So what we did here was we went through what the MAR ratio looks like. We showed that every winner has two sides of an equation for your account. And I also explained to you the danger of going long when we're below the 200-day moving average. That's what you need to get out of this. Basically, when the QQQ is trading below the 200-day moving average, you can reduce your drawdown by half over the last 24 years. I'm not expecting you to trade this system because you trust me, I'll be the first guy to tell you when the QQQ is below the 200. But I'm showing you guys that I don't just tell people don't buy stocks when we're trading below the 200-day moving average for my health. I have 24 years of data telling me that you're going to draw down your account twice as much. That's the point of this exercise. It's not to teach you a new system. And here it is right here. And if you change this to 200 days, nothing will happen. I promise. Nobody will get fired. Okay? That's the purpose of this exercise. So, folks, don't. So now you understand exactly how I knew Kathy Woods was full of. Okay. So now I'm going to talk about HA candles. This is going to be fun. I'm having a great day and I'm getting my mind off of my mom's surgery. As a matter of fact, let me see if my wife has an update for me. No, no update. If I had to guess, they probably haven't even taken her in yet. Whew. All right. Okay. What are Hakanachi candles. So I'm going to explain to you what they are. Now, we're completely switching topics now. What we talked about right now is something that should have been the first lesson when you got interested in trading and investing. That should have been your first lesson. That it's not how much money you can make. It's how much it costs you to make that money. That's the real question. Now I'm going to talk about HA and also the danger or the benefit of knowing your drawdown, because you could so for example, let's say you're in a hedge fund right now, and let's say you find out that your hedge fund gives you 15, I'm making these numbers up, 15% return, the fund you're in, but the drawdown is 60%. Well, your MAR is 0.25. You're not outperforming the stock market. That means you're paying for nothing. So always calculate when you're looking at your fund, always calculate what that mutual fund's MAR ratio is. And also if you're a winning trader and if you have an equity curve, go to Trading Sync, that program that Richard uses, that Omar uses, that Matt and I use, and find out what your drawdown is. So you could see how much heat you're taking on your positions at any given time. Do you know why I trade one or two positions at any given time in the pit? It's to avoid any drawdowns. So we have hardly any drawdowns. That's the reason why. Now you understand why. What I taught you is something that a lot of gurus don't understand. So please, please don't underestimate the value of what I just taught you. Okay? All right. Whew, that was a good lesson, wasn't it, Raleigh?
It was fantastic. And I know, Roger, I'm glad you did this because I think it was about maybe 5, 6 weeks ago that you talked about this. And it was so eye-opening for many of us. But here you are doing it again, and it still has that same impact on the people that are
Well,
here.
this time I showed you actual numbers and showed you the
Yeah.
charts and actually showed you A versus B. And I gave you a beautiful A and B comparison. See, a lot of folks are like, well, Roger, I just keep my money in the market. I get my 12% return every year and I'm happy. I'm like, okay, but at what cost? And they have no answer. And it's like,
Right.
folks, that's how it works. That's the other part of the equation. Did you see how I was able to turn a 12.5% return into a 24% return without
Mhm.
doing anything differently?
Right.
Just by accepting a double. What if I went 75%? What if I went another 24? I could have a 36% return and I could have a 75% drawdown. How much you get up here is a 1,000% determinant of how much you're willing to go down here.
Sure.
And Ken, who's a post PhD in math, obviously I did not teach him anything he did not know, but he's saying this is one of the most important things you have shown us ever. That's what I was trying to tell everybody, Ken, and that is despite all the great things you have done. Folks, this is a post PhD from MIT telling you this is one of the most important things I've shown you. How important do you think it is?
It's huge.
Yeah.
And the other thing is this, Roger, because you made a very, very quick comment about the trading pit and why you take, you're calculating the number of trades that you take because number one, you're looking to avoid a drawdown, which is rarely there. So for those of you that are in an alert service like that and you're working with somebody like Roger, once again, he's very, very aware of these ratios, okay? Extremely aware, and is making recommendations that are basically going to be heavily in your favor when it looks at trading these as to when to get in and when to get out.
Yes, exactly. That's right. The NASCAR guy, John. Exactly. All right. Naples fan, here's the video right here. You could just rewatch it. And again, it's really worth watching. And what I'm teaching you right now is if you're a hedge fund manager, that would be the first thing you would learn. Okay. That's first principle in managing a hedge fund. What the F is your MAR ratio? And when you're managing money, nobody asks you how much money you're making on the year. They ask you what your MAR ratio is. That's it. It's all. What's your MAR ratio? What's your MAR ratio? What's your MAR ratio? That's it. Matter of fact, on my platform, on my trading platform, the screen opens up and the first big thing says MAR ratio on it. It's really important. Okay.
Yes.
Okay. All right, guys. So I want to talk about Hakanachi. Okay, what is Hakanachi? Well, Hakanachi is a Japanese candlestick formula. Now, here what you're seeing is a 5-minute Hackenacci chart, okay? And here what you're seeing is a daily Hackenacci chart, okay? A lot of folks use Hackenaccis for entries, exits, and staying in the trend. Now, hey, Karen the Shark. So now, one of the cool things about HA candles is they can give you a really good guideline. So let's say you're not really good at reading price action. Well, that's fine. You see how it's red here, red, green, red, and then it turns green, 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 green. Well, that means you would just go along till you see this candle here. So in other words, even if you're not good at reading price action, you could just use this as an entry, hold, and then so how do I use these? Well, I use them very specifically. There's an echo because both Matt and I have the mic on and my door's closed and I'm using my computer from my
Roger,
house.
I'd be willing to bet she has two sessions open on her own system because the echo isn't there.
Oh, okay.
We're
So,
good.
all right. So, anyhow, so what you want to do is this. I'm going to show you, and everything I'm showing you on a 5-minute, everything I'm teaching you on 5-minute applies to daily. Everything I'm teaching you on daily applies to 5-minute. So we use them exactly the same way. First of all, that's what I wanted to say. But I don't really care for them on a daily basis. Why do I don't care for them on a daily basis? Because I think they're a little bit delayed on a daily basis. But on a 2-minute, like Richard uses, or on a 5-minute basis, like I use, they're actually perfect for I will show you why. For what? Not for why, for what? Okay. So, this is actual candlestick. This is Hackenacci. Candlesticks use a formula. Each formula takes 2 days of price action into account. What does that mean? It means when you're looking at these, you don't want to buy and sell based on them because the price is going to be distorted compared to actual price of the asset. Because remember, they're using a moving average to get these. So you're not trading off of these. You're using these for when you should enter, when you should exit, and how long you should stay in a trade. Okay. So let me show you. When you should get into a trade. And remember, everything I'm going to show you on the 5-minute works exactly the same way on the daily. There's no difference in what I'm teaching you, except this is a daily, each bar is a daily candle, and here it's a 5-minute candle. That's it. These are my HA clouds, and these are the regular candlesticks. Okay. Here, I'll make them even okay, there we go. Now they're even. So you can see this is 5-minute right here, and this is daily. Okay. All right. So see how we're going red, red. So let's say I want to take a long position. Okay. So what I'm waiting for is a flat bottom. Write this down. I'm looking for a flat bottom candle, a flat bottom green candle. A flat bottom green candle is telling me that the price is starting to go up. A flat topped red candle is telling me the price is about to go down. Now I'm going to repeat this again. A flat bottomed green candle tells me we have one right here and right here, tells me that we're about to go up. A flat topped red candle tells me we're about to go down. Mixed candles tell me nothing. How do I use this? Let's say right now I still like Tesla. I'm watching Tesla. We got out of Tesla like around here somewhere, right? Let's say I still like it and I'm looking for an entry. Well, do I enter here? Do I enter here? Do I enter here? I enter when this candle finishes, assuming it's a flat bottom candle. If this candle finishes and it's a flat bottom candle, I would go long Tesla. How long would I hold Tesla for? Till I see a red candle. Here? No. Down here. What iPhone says, what does a flat bottom and flat top look like?
No wick.
iPhone.
Yep.
Look, this is a okay, flat bottom, flat bottom, flat bottom, flat bottom, flat bottom, flat bottom. These are all flat bottom candles. What is Tesla doing between here and here?
Moving higher.
Flat bottom. This is not a flat bottom. There's no wick at the bottom. It's a flat bottom, flat bottom, flat bottom, flat bottom, flat bottom, and flat bottom. What happens when we see this? We exit the trade. Capiche? So you're seeing monkey business here, right? Monkey business, monkey business, monkey business, more monkey business. Here's a flat bottom candle. You can go long here, but you got to get out right here. Or you can get in right here again, or you can get in right here again. I actually like this one right here. So these are flat bottom candles. Now, if I'm in a flat bottom candle and I continue seeing green, even if it's not flat bottomed, I'll stay in the trade. I'll stay in the trade till I see a red candle. So if I got in right here, I would just still be long right now, or I would wait for this candle to finish, and then I would get in on this candle, assuming it's a flat bottom candle. You get into flat bottom green candles to go long. You get into flat top red candles to go short. See, flat top, flat top, flat top. Now, what would get me out of this trade? Something with green on it. Something with green on it. So what gets me out of a flat bottom green candle? A red candle. What gets me out of a flat top red candle? A green candle.
A green candle. And Roger, just to that point, the candle that gets you out does not need to be flat top or flat bottom. So in other words, if I'm going long, any red candle is a signal to get out.
Yes, any red candle is a signal to get out.
Gotcha.
Yes. So if you're going long, okay, you would, by the way, let me just see something here. By the way, let me just write this. Uh, 485.80 if you haven't gotten out already. All right, so Tesla's now 3 points above our entry. If you $3.70 above our entry, if you still feel like you needed to stay in it, okay?
Mm-hmm.
People are really tough, Raleigh. It's really tough. They're very critical of me. Very critical of me. You know, I get bananas. People slipping bananas when I give them winning trades. It's amazing. It's a mutiny out there, I tell you. I'm just playing around. Actually, people are great. So if I'm going short, what am I going to wait for? I'm going to wait for, assuming all the other stuff I've been teaching you for the last 3 years is there. A flat top red candle is a time to short. A flat bottomed green candle is a time to go long. And you stay in it till you get a red candle. So we would get in right here and we'd get out right here. And in this case, we would get in right here and we would still stay short till this turns red. Okay? Pretty good stuff, right?
It's fantastic. You know, it's interesting. I made the comment before you did this. I said, I said, Roger, in full confession, I don't know much about this, but I'm interested to learn. And Richard wrote me and said, Raleigh, it's really going to change the way you look at things. So I would agree. I would agree completely. And I love the fact, the way that you show this top and bottom, because once again, this has helped me understand when to get in a trade, how long to stay in it, and when to get out. And the cherry on top of everything is this is at the end of a longer process, which has you identify what's the right stock to trade just to begin with, and then what you want to do with it. You're just, following that process, Roger.
Yes. Now let's talk. So I just showed you day trading entries. Now remember something. You don't just use these on their own. Don't just sit there like you know what. And good, Adrian. I appreciate that. I'm sure Raleigh will repost that.
Oh, yeah.
I'll actually repost it right here.
We got it. Blake and I got it, brother.
No. I wanted to post it on the Telegram channel.
Oh, Telegram channel. Okay.
Yeah. Here, let me just post it here. Thanks, Adrian. Okay, cool. So what I wanted to tell you was, so let's say you're swing trading. And now everything I'm going to talk about right now, listen and listen good. Yeah, Richard uses 2-minute Afadias. Richard uses 2-minute HA candles on the SPY, and he's convincing me and Matt to start using them. I'm going to listen to Richard because he's a very smart guy. I like the 5 minutes. Richard likes the 2-minute. There's no setting. They're just HA candles. Okay, I need to start something else. I need to start another topic. But listen to me. So you don't just forget everything I taught you and start using this HA technique. That's not how it works. All the other stuff has to be there. So, for example, on a daily chart, are we keying off the 8-day EMA? Did we make an 8-day EMA? Are we weaker than the market? Oh, and then I'm going to enter when I have a HA cloud on a 5-minute chart. So you don't substitute everything I've been teaching you with these HA clouds. You look at all the stuff I've been teaching you, but if you want to know exactly when do I enter the trade, literally at what second? Well, are you going long? A good time is to look at the 5-minute bar and look for for swing trades, two, not one, but two confirming HA clouds. You want to use the first one if it's really tall. If the first one's not tall, wait for the second one if you're swing trading. Next week and later this week, I'm going to have more classes and more lessons on HA clouds for you. Okay. I'm going to have more lessons for you on HA clouds for you. But I just wanted you guys to start thinking at them. But what you need to know is what a flat bottomed green is a buy and a flat top red is a sell. Just for now, just learn that. And I think I've taught you today more usable. And if you're an emotional trader, if you don't know when to enter, when to exit, these HA clouds are like they're like rails. Like they give you guardrails to help you really determine when you should be making a move and when you shouldn't be making a move. Okay, so I'm begging you guys, please review the video that Raleigh and I just did for you. Review this video. And most importantly, I think it would be very advantageous for you guys to attend a class that Raleigh and I are about to have. And let me just gear up for that. Let me stop my share here. And let me pull up my share. Mr. Raleigh, are you ready?
I am so ready, buddy.
Folks, if you missed Saturday's session, we're going to give you another bite at the apple right now to watch it. It's going to be very cool. It's a members only event. It starts right now, and I hope that each and every one of you pays attention. Please, if you are in the Zoom room right now, please make your way into.
If you're in the YouTube.
Yeah, the YouTube room.
Sorry, if you're in the YouTube room, please make your way into the channel, okay? Please make your way into the if you're on YouTube, make your way into the Zoom room. Sorry about that. I apologize. I can't get it right. Okay. Raleigh, 1, 2, 3. Let's begin. Oh, Blake, please make sure you repost all the testimonials, and thank you so much for the nice words. I appreciate all of them from you guys.
Yeah, and I just like to lead off by saying that if you've got questions, put them in the chat panel, and our plan is to address them at the end of this presentation. Now, Blake is going to be assisting us, and if there's questions he can answer during the presentation, he'll certainly do that, but Roger and I are going to be pretty much laser focused on this presentation, and we'll come back and answer your questions when we are done. But anyway, Raj, I'm ready to go, my friend. We always have to start out by just reminding people that there's a couple of important disclaimers that you need to be aware of.
That's right. And folks, I spent 4 hours preparing for today's session. I think it's worth your time to review it. And let's now move away from there. Go for it, Raleigh. Tell us about all this stuff here.
Okay. So folks, as you know, we develop tools and strategies to the best of our ability, but no one can guarantee the future. There's always a risk of loss when trading, and past performance is not indicative of future results. What you will see today are some of the best examples over the last few months across all of the public trade research services that Roger provides. There were bigger winners, there were smaller winners, and we had losers as well. But always remember, trade at your own risk and see our terms on the Trading Pub homepage for more information. And also, folks, let's just get real, okay? In trading, we've got to know and realize this fundamentally, there will be losers. There is no black box miracle system, despite our best efforts to find one, that prints out winning trades automatically. It's not possible. The whole purpose of our research and work with the traders is to help give you an edge in the markets. And if you can't handle a losing trade at this point, then you really shouldn't be trading with real money. And again, folks, losses in trading have occurred and they will occur in the future. So, folks, my name is Raleigh White. I'm the senior manager and trade show host. And as you saw by that picture, pretty fresh.
Very cool looking guy. Very,
Man, I
very
tell you
cool.
what, I am ready for action in that picture. Anyway, today Roger and I are going to tackle some of the most important questions